Welcome back, everybody. Please come and sit down. I can tell you're all extremely excited to be talking about banking regulation, because I know that that is a subject close to everybody's heart. We've got a very good panel today, many of whom I've had the pleasure of working with in the past in Brussels to talk about this subject. And we're going to try and have a conversation slightly different from the normal conversation we have about banking regulation, the details of CRR and Basel 3 or 4 or 5 or capital buffers. And I want us to have a broader conversation to think more philosophically and politically about the nature of regulation and to try and answer the question that the agenda poses as to whether we have the right regulatory framework for banking to enable us to encourage growth. So I'm going to invite the panel up onto the stage, who are a mixture of, I think, poachers and gamekeepers with a rich background both in being regulated and having been regulators. So please join me. First of all, Greg Baer, who I think started out at the US Treasury and is now the president and chief executive of a campaigning organization that specializes in banking regulation. We have Andreas Dombret, who started out as an investment banker, I hadn't realized that, and then went on to fill some of the most important regulatory positions in Brussels, in the Bundesbank, in the ECB, at the Bank for International Settlements, and also, I think, on the Basel Committee, and Sylvie Goulard, who started at the Commission, then was a member of the European Parliament, a French politician as defense minister, and now the deputy governor of the Banque de France. So could you all perhaps join me, and we'll start our discussion. Well, look, thank you very much for coming along. I think I want to start really with one of the points that Anna made in her opening remarks, which was that the regulatory framework within which many of us operated and some of those rules we helped shape was set up in response to events now 14 years ago. And so that, I think, prompts an obvious question as to whether 14 years on we do have the right kind of framework in place. So I think one way of getting into the subject, if I may, is to start by asking all of you in turn, imagine you have a blank sheet of paper and you're sitting there as former regulators thinking about the biggest risks we face today in financial services. What would you say those biggest risks are that we should be concerned about? Can I start with you, Greg, since you're in my eye line?
Sure. I mean, at the moment, certainly, I think the greatest risk to financial services is geopolitical risk. I was remembering last night, that it used to be a US military strategy. It was referred to as win, hold, win, which was the notion you should be able to fight two major wars, win the first one in relatively short order while holding this on the second, and then when you're done with the first, you win the second. And the question is, do we have that sort of resilience and financial stability right now, given what's going on, at least on one front? And there, I think there's a lot of reason for present concern. We won't get too into regulation, but I think you've seen, if there were a risk off trade, and a lot of people wanted to sell at the same time, there's a reduced ability of banks and dealers to intermediate, either directly or by funding others who want to buy. And that might necessitate, as we've seen in the past, central banks coming in to serve as the market maker of last resort. A phrase that didn't used to exist and they used to deny they would ever do, but has now become, I think, part of the lexicon, unfortunately. But that's a tough thing to do right now because we're supposed to be in quantitative tightening, not quantitative easing, and bond buying is quantitative easing. And so at that point, you would have, I think, one foot on the gas pedal, one foot on the brake. which of course means you've got to push down on the gas pedal a little harder, which means raising rates even higher. So I think now would be a uniquely bad time to have a second sort of break in the system, as I'm not really sure we're prepared for it.
Okay, thanks. Sylvie, what worries you most in the financial services?
Well, first of all, thank you for inviting me. It's great to be in this conference. No, I could not agree more. We are experiencing geopolitical change of great magnitude. But I would like to point out that there is a visible war, the one in Ukraine after the Russian aggression, but the invisible war of climate change is also continuing. So for me, this is a poly-crisis. There is the need to look at sustainable growth in a changing world, in a fragmented one where cooperation cannot be taken for granted, and where we should, at the same time, tackle one of the most difficult issue for mankind, which is climate change and nature-related risks.
Thank you. Andreas?
Yeah, I'm very worried presently about this very soft sofa which I'm sinking in. On a more serious note, we are, of course, in a very challenged macroeconomic environment, where we have very little predictability of what's going to come and where the level of uncertainty is higher than I can think of. So this will, central banks and others will react to that. So leaving that aside, I think that the banking market and the insurance market is so well regulated, and we have so high buffers and liquidity and everything there that I don't expect the biggest risks to coming from the financial services sector itself, but from first technology, because we don't really know that well what happens if technology fails and what kind of consequences will that bring, and secondly, the shadow banking sector. When I got into office in 2010, there was a lot of work on the shadow banking sector. That relaxed for 10 years, but coming a little bit back to what you said about the markets, the shadow banking sector is worrying me now more, let's say, than the banking sector.
Okay.
And the sofa.
So, but I think although you emphasize different things, the common theme, I think, is we're not saying, as Andreas said, that the banking sector or the capital position of the banking sector is the biggest threat that we face. And yet, the behavior of the regulatory world still seems to carry on cranking out approaches as though the lack of capital in banks is still a high concern. So let's perhaps bank that as a first point. But if we then turn to think about the theme of the conference and growth, if I heard it correctly, Anna Botín quoted a number which was 50 basis points on the cost of capital costs you 1.5 trillion euros of investment. And if we accept that the biggest challenge in Europe is to get growth for all the reasons we've discussed, do you think then that the bank regulation we've got is set up appropriately to enable that growth to happen? Can I start with you, Andreas?
Okay. So we have two sets of regulation. One is the microprudential regulation, the normal, let's say, bank or insurance regulation we all know about. And then, of course, there's the macroprudential regulation, the financial stability aspects, where we are still learning, or where our colleagues like Sylvie and others are still learning, but that is, of course, the future. And whether or not we are well set up will depend on how much progress we make also on the financial stability side. I personally believe that a good bank supervision and bank regulation needs to be holistic, and needs to look at all the risks and needs to prioritize, because my fear is that each and every branch of regulation is putting up a new regulation, and then at the end, the cost is overwhelming and it's not interlinked, and the burden gets too high. So a holistic approach is important, and it must be forward-looking. If it's very static and backward-looking, you're not addressing where the main aspects of future risks and future crises lie. So try to be forward-looking and holistic and as little static as possible, and both micro and macro prudential.
Okay. Sylvie?
Well, if I may, I would like to insist on something else. As Europeans, and in a very unstable world, we have the single market. By the way, we could pay tribute to the UK for having always been an active motor when it was within the Union. And here I was a little bit puzzled to hear, okay, we don't have capital markets union, we don't have banking union. We should continue and make all possible efforts to make sure that our companies, our banks are operating in a real single market where barriers are removed, where capital allocation is done in a way which is optimal and which helps to create the sustainable growth we want. So this is for me one of the key elements. The second one is, of course, as finance, as capitals are moving worldwide, to make all possible efforts in all multilateral bodies to encourage, we have seen this morning, we need some joint approach on cryptos and all the innovation. We also need, of course, to work further on climate. So we cannot deal with the questions we have in front of us in isolation, at least not with the US, but even more broadly. We had a nice plea this morning to give Africa a chance and to rely on the youth. So this is, for me, the key question in not only a fragmented world, but in a world where all political debates are more and more inward-looking. How can we make sure that whatever the rules we want to put in place, it is done taking into account the European interactions and the interaction with the rest of the world?
Yeah.
I guess I'll go back to your first observation, Jonathan. When I think about banks and their capital buffers and their other capital buffers, and then their buffer to make sure that they don't violate their buffers, the analogy I use is it's like the Maginot Line. I mean, you have these incredibly highly fortified banks where the risk is probably going to go around. I've stopped using that analogy in the United States because nobody knows what I'm talking about, but I think maybe in this audience somebody might actually know what that is. But I think with capital regulation, which is really the driver of more than others about economic activity and growth, I mean, it's tough on sort of there are two issues. One is sort of stringency, how high should the levels be? And there it's a tough trade-off. It's, the benefit of high levels is, or high requirements is, banks are less likely to fail and you're less likely to have a financial stability crisis arising from a bank failure. The cost is, I think as we've just talked about, lower economic growth through lower lending, and also an increased risk that a financial stability crisis will occur outside the banking industry where you're effectively pushing the risk by capitalizing it out of the banking system. And I think regulators maybe tend to favor the first over the second, and maybe there will be a little bit of a realignment. But I think also, and looking sort of as an outsider at Europe, the other level is, or the other issue is volatility in capital requirements. Because if you think about who invests in bank stocks now, these are not growth stocks. So you, as a former investment banker, they're not tech firms. They're effectively value stocks or maybe even utilities. And if you're investing in a stock like that, what you want is a predictable return on equity and a dependable dividend. And there, in Europe you have Pillar 2, which is whatever the regulators say it might be. There's no parallel for that in the United States. So when you go to your investors and say, well, I can't tell you what your return is going to be because I can't tell you what my capital requirement is going to be. And then I also think those types of investors also value a dividend. And I think it was a mistake to cut off dividends and repurchases in 2020. It was viewed as a temporary measure, but I think it was a permanent decrease in the franchise value of banks and an increase in their cost of capital. And you can say, well, it was just temporary, but for investors like that, it's under stress is exactly when they want to be able to depend on their dividend. And so now you've sent the message to, I think, potentially European bank investors that you can't count on the dividend and you won't know what your capital requirement is going to be. And I think the US does a little better job of that.
Right. Well, I want to come on in a moment and talk about the US and the divergent path. But just on Andreas's point about holistic approach, a more dynamic, less static approach, a more forward-looking way of thinking about regulation than rear mirror, which is what I think we have been doing since 2008. Do you have any thoughts as to how one might develop that idea? I mean, institutionally, how could one change the behaviors? Is it cultural? Is it structural? How could we try to get to a more holistic, dynamic, flexible, rational approach where regulation is a grown-up discussion between regulator and regulated, not a battle over a religious text, which is what it often feels like. Do you have any thoughts as to how one could try and make progress there?
First of all, many are forgetting that the objectives of bank supervision and the banks themselves is exactly the same. Stable banks, a stable environment in which you as a bank can grow and you as a central bank can have monetary policy transmission. So they are on the same side. On the other hand, you have to have rules, because if there are no rules, there will never be a level playing field. You need to treat the sector the same as much as possible. There always can be some leeway, but not too much leeway. Now, what you really have to do is you have to supervise where the risks are. And for that, you need to have a common understanding. I believe, especially given the war in the Ukraine, that we need a much better understanding between fiscal policy and monetary policy, and we need to be on the same map. Everybody needs to be on the same map. And then it is less of a fight and more of a dialogue. And so the behavioral issues you are pointing to is correct. There's a lot of lecturing.
Yep.
The previous, I shouldn't say this, but I say it anyhow, the previous approach of, I think, in Spain, of bank supervision was very much lecturing. Now, we are more in a debate about business models now. And that is the right thing to do. If you, as a supervisory authority, discuss the business model, you discuss the risks, you discuss the future, you discuss how you are positioned. So that is what I have in mind in terms of a further approach.
Okay. Any other observations to add?
I guess I pick up on one thing you said, Jonathan, which is, I mean, the first rule of correcting a problem is to recognize you have a problem. And I think there is now a widespread understanding that buffers have not worked. Most notably capital buffers, but with less attention, liquidity buffers. They have, and if you think the purpose of those buffers was, well, we want to take the lower growth, but we want to have capital liquidity available in stress where banks will draw down that capital and liquidity to support the economy. That was the whole idea. And they have not, for a variety of reasons. Some of it supervisory pressures, some of it market pressures. But we now know, and I think there's been a good acknowledgement even in the public sector, that these are not serving that purpose. And then the question is, well, what are you going to do about that? And there are other aspects I think in US law and in European law where the accounting standards are now pro-cyclical, the stress tests to some extent are pro-cyclical. And I think there's beginning to be a revisiting of that. But it needs to be sort of an open-minded revisiting. The answer is not this to add yet another counter-cyclical buffer on top of all the pro-cyclical buffers. And I'm actually something of a skeptic that at least in the United States, the counter-cyclical buffer would actually be counter-cyclical, and I think it's more likely to be pro-cyclical. But at least I think a discussion has begun about that. It may be easier on the liquidity side because it somehow seems less political. But I think that's a clear way to produce more economic growth without impinging on safety and soundness or financial stability.
Maybe I'm biased because I was at the European Parliament at the time where we adopted several rules, but you used the word purpose. The purpose was clear. We should not forget the purpose was to strengthen the financial sector after a crisis that hit the world economy with consequences for the most vulnerable, etc. I remember our roadmap coming from the G20 was crystal clear. Now maybe it is time to move to something else, but I think we will discuss maybe later that there is a need for accountability. Rules in democracies at least are not made by experts or technocrats. They should be the result of a political process. between the European Parliament and the Council of Ministers, where all participants are elected and legitimate, and then if there is a need for a new framework, then of course the rules should be changed and the way we implement them. But you need some ownership as well in the population. You need to make sure, and Anna said this morning, she said, we were considered part of the solution during the COVID crisis. This is also because the rule had strengthened the banks, and the banks were in a position to play a very constructive, positive role. And so I think we should not be too negative on what was the framework or is the framework. We should hurry up in taking the decisions to change what needs to be changed.
Okay. Should we talk about accountability now, since you've raised it? Because I think this is linked to the point that Andreas made about having a more dynamic system. It's linked to the point about the nature of risk changes over time and how do you adapt your regulation to that changing risk. And I think it's also linked, as Sylvie's just said, to one of the big political themes of our time about control and accountability, where in all our countries one of the themes is people wanting to have more control over their lives. Yet in financial regulation, which I think of as shaping our entire economy and our society, the decisions that regulators take have a massive real-world impact on the lives of millions of our citizens. Our politicians have said, this is too difficult for me, I'll leave it to you, you're clever, you sort it out, and then when it doesn't work, they attack the regulator for making a mistake. But they don't take responsibility for setting society's risk appetite. And my basic view is our risk appetite in society has been falling in all our countries, and that has an impact on growth. So Sylvie's just said something about accountability, but do we think there are ways that we can address what I would call an accountability deficit? And do we think that regulators need in some way to be more accountable? And is it the job of the politicians to make them more accountable, or can they themselves, through their behavior, connect themselves more with public opinion? Andreas, do you have thoughts on this?
As a former investment banker, I have no idea about accountability in the first place, but having said that...
maybe as a former member of the board of the Bundesbank.
Maybe, yes. And that was after my work in the investment banking area. Now, Paul Tucker wrote this book about the unelected powers, and he was very early and very right when he wrote that. I'm worried about something Sylvie mentioned en passant, and that is, she mentioned the G20, because that was the forum where leaders were sitting together, and I just have the big fear that given the war in the Ukraine, that the G20 will become a talk shop, just like the United Nations and the IMF potentially too, and that there will be lots of speeches, but no decisions being taken. So I think it's even worse than you phrased in your question. Where is this forum in the political arena right now, that it doesn't become a horse trading on the one hand, and on the other hand, we still have multilateral agreements, because you need global agreements in order to prevent uneven level playing fields. I'm not sure how we get that, because the G20 will probably cease being this crystallization forum where it used to be. So I don't see how we can replace a Basel Committee, for example. The only thing what we could do is that we have other political forums which then approve what has been crafted in the Basel Committee, but this is happening, for example, with Basel III also right now. It's not that the guys and the ladies and gentlemen in Basel agree on something and then there is no political process of approving this.
Yeah.
You know, it has to go to the European Parliament, et cetera, et cetera. My forecast is it would even be more difficult to find a forum where all of this is being decided, because in the G20 you have China, you have Russia, you have certain countries which, if you have walkouts of G20 meetings, what kind of forum is that? You know, we never had this in the past, so I'm very worried about this.
Okay.
I don't see a solution right now for myself.
No, it's tricky. I mean, we've got quite an acute form developing in the UK at the moment, because the government's about to introduce a bill, or has introduced a bill, to basically give the regulators new powers on the back of us leaving the EU and setting our own regulatory framework. So new powers to be more flexible, all the things Andreas was talking about. But they've also, I think, come across the point that what do you do in the circumstances where the regulator starts acting in a way that doesn't seem proportionate or in line with your economic needs? And so they're looking at a call-in power where the government can say, this regulator has, we think, hasn't acted in a rational way. And of course, that then takes you straight into the argument about regulatory independence that the whole thing was set up to do.
The independence is a monetary policy more than a regulatory issue. I don't think that, you know, some countries have a separation between the central bank and the supervisors. So the independence needs to be there in monetary policy. I'm not 100% sure that you need 100% of regulatory independence.
Okay. That's a good point.
Yes, I just add, I mean, in the United States, it's interesting. I think we're actually going in the opposite direction. Not to be legal nerdy, which is even worse than being bank regulation nerdy, but, and it's really coming out of the judiciary now, and a conservative judiciary, where there is, well, I think, 3 developments. First, less inclined to defer to agency judgments when they're interpreting laws. It used to be what's called Chevron deference, that you basically, as long as they can come up with a plausible reason for their rule, it will be approved. The next is something called the major questions doctrine, which was just reinvigorated, which is the notion is we presume that Congress will not delegate to agencies you know, sort of blanket authority if there's a major question involved. And so recently a rule was struck down on that ground, saying, no, you don't have interpretive authority there. It couldn't have meant that because Congress never would have let you do that. The big one to come, perhaps, is what's known as the non-delegation doctrine, which has not been an issue in the United States since the 1930s, but basically the notion that Congress cannot delegate some of its powers to agencies, and that power has to be explicitly delegated, not sort of given to the agency's judgment. You also see quite related, maybe a fourth. I mean, the CFPB, which is the Consumer Protection Regulator, was just, its funding was just struck down because it was too independent of Congress. We'll see, the Supreme Court will probably decide that next year. But in all of these areas, a more conservative judiciary, I think, and now perhaps aided by a more conservative Congress in next week, is pushing to restrict the ability of regulators and push it back to the legislature.
Okay.
Maybe 2 points very quickly. Firstly, on independence and accountability. You can be independent and accountable.
Yeah.
The president of the ECB is going every quarter to the European Parliament and explained the policies, the decisions taken, et cetera, et cetera. This is the first point. We should not consider that independence is acting in isolation, not taking into account not only what market participants think, but also what ordinary citizens experience in their daily life, above all on inflation. And my second point is that, well, we are only beginning to test independence for central banks and others in a context where difficult decisions are taken. It's not the same when you are in an environment of low inflation and what you do is to put money in the system, or when you are in a situation where you need to normalize, not to say tighten. So this is one of the, for the European Union, 30 years Maastricht Treaty, 20 years Euro is quite young. And now we are entering a phase in which we are going to look at independence in another way.
Yeah, okay. Well, thank you for that. And I think the point about the difference between independence and accountability and between the monetary responsibility and then the regulatory supervisory responsibility, I think is well made.
Remember that I said that I think, despite all the independence I fully agree with, we need to be on the same page between fiscal policy and monetary policy. And I didn't say this lightly. If you don't have the same goal, then you have a problem. So
yes.
You have to try to find common ground between those.
I agree, but for Europe, for the euro area, it means one monetary policy and soon 20, because Croatia is going to join in January, fiscal policies. So it's more complicated than in the US, in the UK, or in our countries before the creation of the euro. We should keep this in mind. I mean, the risk of divergent fiscal policies is much higher.
Yeah. Okay. I'm just going to move us on a bit. We tiptoed towards it, and we maybe don't need to spend too long. Differences between US and EU on the regulatory front. I mean, if one looks at whether it's cause and effect, it seems to be the case, or some people say that the US banking sector is doing better than the European banking sector, that there's more US investment coming into Europe because in some ways maybe the European banking sector is more constrained. Do you share that analysis, and can you explain some of the factors behind the apparent divergent path between American banking and European banking? Do you want to have a go first, Greg?
Sure, big topic. I mean, clearly the one advantage that the largest internationally active US banks have is capital markets, which is a natural hedge on the banking business. Ended up doing very well in 2020 across the board. And that's the sort of activity that they're exporting to Europe and doing quite well in. I think on the retail side, the US just benefits from having a very strong economy, a very strong consumer demand, and a very sort of regulated and understood system of federal deposit insurance. And people have no doubt about putting their money in their bank, and banks have a dependable through the cycle source of funding and are able to leverage that. And that includes not just large internationally active banks, but the thousands of really small US banks. But the capital markets is extraordinary. I mean, when you think about, if the bank regulators, as they did, try to dissuade large banks from doing leverage lending, well, their customers who are unhappy about that, they can go issue high yield bonds. There's sort of a natural release valve there that I don't think is, well, I'll learn soon, is present here.
Any points to add?
Yeah, the difference is in the capital markets, pension funds, citizens who are maybe less risk adverse. I think I don't like to say it, to be honest, but we are aging societies, not always aware that their trade-offs between generations are not very fair. And maybe we could learn from others, taking also into account the fact that you have the dollar, you have a federal government, you have an army, and all this is part of power and perception of power worldwide.
So you'd say that the difference is more structural than regulatory in terms of the performance?
Yes.
Yeah. No. But do you think...
Let's be modest, even if this panel is a very important one.
Do you think regulation plays any part? That's what I'm not saying.
It plays in part, but we should not ask regulation to deliver what we don't want to get at a political level. I mean, for me, 30 years after the creation of the euro, we should ask ourselves what we want to do with the single currency, which was meant to create a political process and increase make all countries converge, etc. If we don't ask ourselves these questions, and also more structural on the existence of capital markets, we cannot find a solution. That's the reason why it's always good to look at what the US are doing, but not always relevant, above all, if we are not ready to pay the price for all the things we pretend to wish.
Okay, we're just coming up to the end. I just want to touch on something that Andreas alluded to, which is the question of the behavior and culture of regulators. I think people often mix up, when they complain about regulation, they mix up the hard letter rules, the regulation, and then the way that they are implemented by the regulators or the supervisors. And I've heard Andreas talk before about the potential maybe for thinking about how supervisory behavior and culture maybe needs to be addressed. Is there something you'd like to just share with us on that?
Now, first of all, supervisors and supervised banks, are two sides of the same medal. That's the way I look at it. And one cannot do without the other. If there are no banks, there are no supervisors. If there are no supervisors, the banking market is going to be quite chaotic. You need, this is my first statement, so you have to look at it as a mirror. But I believe that supervisors have the obligation to think about the costs they are introducing and they are putting on the banking sector. And some of them may be intended cost, and some of them may be very unintended cost. And you really have to have a dialogue with the market to understand the concerns of the banks and then react accordingly. There is a reason why, for example, the Bundesbank is in Frankfurt and not in Berlin, because you want to be closer to the banking market. That doesn't mean that you need to do what the banking market wants you to do, but you need to understand what the banking market is thinking about and is worried about, and do you differentiate between intended and unintended consequences. And this is really, really, really important. So you're not having technocrats who put out the right document, but you have somebody who thinks about this, as I said, in a holistic way and tries to have a certain consequence. And this cannot be overburdening the banking market. We haven't discussed the word financial stability very much. I mentioned it briefly, but you have to bear in mind that there are many risks out there, and you address each and every risk. Yeah? And the risks themselves may be rather small, but the accumulation of the risk may lead to something which is really problematic. And the same holds true for supervision. If you have a lot of supervisory directives and then you build a monster which is then too much, then the financial stability is also in danger. And this needs to be really understood. And the way supervisors should work is not only see the downside. It's a little bit, supervisors are a little bit like rating agencies. They see the downside and they never look at the upside. So there is no entrepreneurial idea in this whatsoever. So you have to look at the risk, but you also need to see where could be the potential upside of what I'm doing, and which upside do I want to allow and which upside do I want to cap. And if we don't have that, we do have the wrong behavior. And this is why I'm interested. I was trying to find a good way to get this, to say this, what the ECB is going to say about the tax on Spanish banks. Yeah. Because this is a financial stability issue, and that is something which is not coming from the central bank, but I'm wondering how diplomatic or undiplomatic the ECB will be, because the vice president quoted Ben Bernanke. I don't think in 1983 he did write about taxing banks and creating an uneven level playing field. We need to come onto the same page, and between, as I said, fiscal policy and bank supervision and monetary policy.
Okay, thank you. Any last remarks, Greg?
Yeah, just a quick addendum. I think what we're observing is basically a semantic problem. The first good step would be to stop calling them supervisors. At least under US law, their authority is to be an examiner. They come in, they examine the bank, they look at the books and the records, they decide if you're in compliance with law and whether you're engaged in unsafe activities. There's no reference to supervision. It's very different to come into a bank and say, I'm here to examine you, and to come into a bank and say, I'm here to supervise you. And I think supervision is now the mindset, and it's yielded what I call examination as management consulting. And it's increasingly an emphasis on immaterial matters, because a lot of the material matters are now capital liquidity. They're taken care of outside of the examination function. But when I talk to bank CEOs, I hear more complaints about the examination function than the regulatory function. Yeah. And I think it's the management consulting.
Yeah, agreed. Sylvie, final word?
Well, again, for Europe, single rule book, as simple as possible, and sophisticated, agile supervision, examination, and keep in mind that climate change is the main issue for financial stability in the coming years. There is a report, obviously, published at the eve of the COP27 saying that for Europe, it is even an increase in temperatures higher than in other parts of the world. Sometimes when I talk about climate and nature-related risks, people in Europe make as if it was indirect. So it's going to hit the others elsewhere, and we will have some consequences. No, it is now. And when I came, unfortunately, by plane, I observed the drought here in Spain. So let's keep it in mind.
Okay, thank you. Well, look, I think there's some agreement that, maybe it's time to think again about the way we regulate, particularly banks 14 years on, that we need to see if we can develop a more holistic, dynamic, forward-looking approach to regulation, that we should think also about the way that this distinction between the phrase Greg used, supervision and examination, which is not the word we use, but I get the distinction, the culture of regulation, and to focus more on what might be the risks in future rather than constantly to crank up regulation on the risks of the past. So with that, please join me in thanking our panel for a very entertaining discussion. Thank you.
Thank you.